Welcome to This Explainer. Today, we're diving deep into the complex life cycle of business compliance. Now, instead of looking at structural regulations as this massive administrative burden, we're going to break them down as a strategic roadmap. Because here's the thing, understanding the underlying mechanisms of compliance actually unlocks a highly powerful framework. It fundamentally protects and scales your operations. The whole goal of our analysis today is to transform those raw, dry regulatory requirements into actionable structural advantages.
So, what separates a thriving business from a total regulatory nightmare? I love starting with this question because the answer almost always comes down to understanding the invisible mechanisms of administrative rules and cause and effect record keeping. A thriving enterprise actually anticipates regulatory triggers, right? They build robust internal systems. On the flip side, a struggling operation is constantly reacting to things under duress. It is entirely about structural awareness. When your operational data is perfectly mapped to external compliance requirements, your business shifts from a posture of vulnerability to one of absolute, complete control.
Here's our agenda. We'll be covering entity formation and maintenance, operational record-keeping fundamentals, navigating federal tax obligations, specialized industry tax rules, preventing fraud and scams, and finally, selecting certified professional help.
Let's jump right into Section 1, Entity Formation and Maintenance.
Compliance essentially operates on a dual-layered system. As you can see, local, state-level operational fees exist in a completely separate silo from your broader federal reporting duties. Understanding this bifurcation is absolutely crucial. For instance, a business might owe zero federal income tax based on their annual revenue or heavy operational deductions. But the governing state will still mandate its own specific maintenance filings to keep the legal entity active. Failure to separate these two distinct mechanisms, that often results in unexpected localized penalties that can literally jeopardize the legal standing of your entire organization.
Let's talk about the franchise tax, because it operates entirely independently of your profit margins. It's essentially the baseline structural cost of legal existence within a specific jurisdiction. A lot of founders completely overlook this underlying mechanism until a penalty hits their desk. Basically, you're paying for the privilege of the legal structure itself, even if your transaction volume for the year was absolutely zero. It's a maintenance mechanism ensuring the state registry remains accurate, and honestly, maintaining it is completely non-negotiable if you want to preserve your liability protections.
Moving on to Section 2, Operational Record-Keeping Fundamentals.
3 years. This is the absolute minimum retention period for client records, receipts, and compliance documentation post-filing. Think of this 36-month buffer as the standard statutory window you need to survive an audit and mathematically substantiate your reported figures. If you purge your foundational data before this window closes, you instantly lose your analytical leverage. You're rendering your business structurally defenseless against any inquiries regarding past operational metrics.
Now, a really common implicit assumption out there is that perfect, pristine records are required from day one. In reality, reasonably reconstructing missing data via supplier logs or digital appointment books is a totally accepted analytical practice. But I want to highlight a prime example of cause and effect record keeping from the expert analysis, the business use of personal vehicles. This is a massive area for structural financial optimization. The standard mileage rate, which sits at 70 cents per mile right now, is an allowable operational deduction, but it requires strict logistical tracking. It's not an automatic concession, it's a precisely calculated mechanism. If you systematically document the exact date, the exact mileage, and the specific commercial purpose of each trip, that deduction is mathematically unlocked. Every single logged mile translates directly into a quantifiable reduction of your taxable income. It shows exactly how logistical precision actively drives your bottom line.
I love this insight because regulatory guidelines actually allow for flexibility, which kind of humanizes the raw data. Whether you're operating a highly mobile service unit or a specialized physical facility, your financial footprints can be successfully reverse engineered. Electronic files, PDF invoices, cellular location data, extensive supplier databases, they all serve as valid puzzle pieces. The whole objective is to structurally recreate the financial reality of your business environment. So compliance isn't just about achieving absolute initial perfection. It's about possessing the analytical capability to accurately reconstruct the truth when you're called upon to do so. Let's look at Section 3, Navigating Federal Tax Obligations. Notice the pattern here? Regulatory bodies are systematically tightening the reporting net on all digital and third-party payments. The automated reporting threshold is aggressively dropping, and it's engineered to reach a baseline of just $600 by 2026. The entire objective of this mechanism is to comprehensively capture the vast decentralized data of the gig economy. By lowering that threshold, these automated systems ensure that all independent contractor activity and digital marketplace revenue are structurally accounted for in the broader economic system. They are literally eliminating historical blind spots in revenue tracking.
Now, this dynamic addresses a very common structural misconception when it comes to digital ledgers. Splitting a shared bill or doing personal reimbursements, that will not trigger a commercial tax event, no matter what the transaction volume is. The reporting algorithms specifically target the digital sale of goods and services. So, selling a monthly subscription or getting paid for freelance consulting, that generates an automated report. But personal peer-to-peer digital transfers remain intentionally outside that reporting net. The system clearly differentiates between commercial revenue generation and personal capital circulation.
Section 4, Specialized Industry Tax Rules. £55,000. If a commercial vehicle hits this specific weight threshold, it triggers a highly specialized heavy highway use tax. Analytically, what is absolutely vital to grasp here is that this structural liability is tied directly to the vehicle identification number, the VIN, rather than just the current owner. The tax mechanism actually tracks the physical asset itself across its entire commercial lifespan. It's treating the vehicle as the taxable entity based on its impact on public infrastructure. However, look at this direct cause and effect relationship regarding physical usage. Keeping operations strictly under specific public highway mileage limits, so 5,000 miles for standard commercial use or 7,500 for agriculture, completely suspends that heavy vehicle tax. Your operational limits directly yield tangible tax benefits. But of course, the mileage data must be meticulously captured to leverage the suspension. The system is essentially offering you a relief valve, but it requires you to definitively prove the asset's limited impact through strict, verifiable logistical tracking. Furthermore, acquiring clean energy fleet vehicles injects incredibly high-value credits into your compliance profile. This is a highly calculated mechanism. The incentive isn't just some flat rate. It's strictly capped by mathematical formulas based on the vehicle's cost basis and incremental weight parameters. So accurate data tracking at the point of purchase is literally the only key to unlocking these incentives. The structural intent is obviously to subsidize operational upgrades, but the execution demands absolute precision in how you value and classify the asset. Let's shift gears to Section 5, Preventing Fraud and Scams.
We need to talk about corporate identity theft because it rarely involves sophisticated hackers breaching a mainframe. Instead, it relies almost entirely on basic social engineering. Malicious actors use simple phishing emails targeting administrative employees to steal tax forms and trick the human operators. Because of that, implementing strict security measures like constantly updating endpoint security software, maintaining isolated encrypted backups, enforcing complex passwords, and universally mandating multi-factor authentication is structurally non-negotiable for securing your digital borders. These 4 steps form your active perimeter defense against operational sabotage.
But internal vulnerabilities also exist when it comes to external professional consultants. Keep an eye out for red flags, like asking for signatures on blank financial documents, or calculating advisory fees based purely on the size of the refund they generate for you. These are clear indicators of predatory behavior designed to manipulate the system for short-term gain. And what is the ultimate analytical consequence of this? It's a severe liability shift. The bad actor eventually vanishes, and the core business owner is left legally and financially holding the bag for the fraudulent data submitted into the system. Which leads us perfectly into Section 6, selecting certified professional help. As you can see, there is a strict, legally defined hierarchy of professional representation. Not all advisors possess the legal authority to actually defend a business entity. Enrolled agents, certified public accountants, and attorneys hold unlimited representation rights. That means they have the structural clearance to advocate for your business at every possible level of an audit, appeal, or dispute. Uncredentialed preparers simply lack this legal capability. Their utility stops entirely the exact moment an external audit or inquiry begins. The fundamental baseline of professional accountability is the Preparer Tax Identification Number, or PTIN. Let me be clear. Never hire an external expert who lacks this federally mandated credential. Without a valid PTIN, a preparer is completely unrecognized within the broader structural system, which makes using them an immense, unnecessary operational risk. This number is how regulatory bodies track professional oversight, ensuring that the entity handling your highly sensitive financial data is tethered to a standardized system of accountability. By deeply understanding the structural life cycles, the underlying rules, and the precise cause and effect relationships of your operational data, like meticulously tracking your vehicle mileage, the script flips entirely. Regulatory compliance transforms from a reactive, hidden vulnerability into an optimized, proactive engine for your business's growth and longevity. So, the question we have to leave you with today requires some deep operational reflection. Is your current compliance strategy an unmanaged liability, or is it an active, carefully engineered competitive advantage?